This material has been reproduced and communicated to you by or on behalf of Deakin University in accordance with Section 113P of the Copyright Act 1968. The material in this communication may be subject to copyright under the Act. Any further reproduction or communication of this material by you may be the subject of copyright protection under the Act. Do not remove this notice.
Okay, let's get started. Good afternoon, everyone. Welcome to week 3. Today, we're going to continue our discussion on the topic, the time value of the money. Okay? Let's settle down, please. Okay, let's get started. Last week, we introduced the most important, the foundation concept in the finance for the entire financial economics is called the time value of the money, right? At the beginning of the class, we provide the intuition, we explain why does money have a time value, right? And then we clarify some basic the measurement issue. Because of the time value of the money, $1 today is not $1 tomorrow. And hence, the value of the money is changing, is moving, is varying along the time dimension, right? So we introduce the simple interest, the mechanism, and the compound interest mechanism to work out the present value of a cash flow that to be received in the future, right? And then we also introduce how do we calculate this value variation using the both, simple interest framework or the compound the interest framework, right? But today, we're going to take a deeper dive into the topic and then introduce to work with multiple cash flows, right? So it is just one step further, but still within the same topic, okay? So if you believe evaluating valuation one single cash flow is important, but I can give you some convincing evidence evaluating and working with multiple cash flow that is occurring at different time is more important, and it is indeed more practical. Okay, let me give you some example. to have some motivation. Okay, what I'm showing you here is the index fund, right? So suppose we want to invest in the stock market, right? And we don't want to bet on a single stock, right? It's going to be too risky. What we do is we buy the entire stock market index, right? So exactly as this one, it is called SPY. That is tracking the performance of S&P 500 index, right? So if you buy a share of the fund, right, so you have a exposure to the entire S&P 500 index. So equivalently, we are buying the 500 companies included in the index, right? Take a look at the page. What I'm showing you is the dividend, the paying history, right? Did you see any pattern here? So of course, if you buy the stock market index, we are entitled to receive like a pretty much regular cash flow, right? And in particular, we are expecting quarterly dividend, right? Remember, for the U.S. stock, right? So if they pay dividend, most likely they pay a quarterly dividend, okay? That is exactly what we see here. If you buy the top 500, the U.S. stocks, right? So we are entitled to claim to receive the quarterly cash flow in terms of the dividend, okay? That's interesting, right? And then the practical question is that how much we should pay for each share of the index, right? So one of the arguments is for the long-term investor, essentially what we are owing is we are entitled to receive the long-term dividend, right? If that makes sense, how much we pay for that right, how much we pay for that index today should be the present value of all future expected dividend, right? Does that make sense? So here, apparently, the task for the valuation job is to deal with multiple cash flows, right? And hence, it seems to us that what we learned last week is too simplified, right? So we have to learn some toolkit, the useful toolkit, to deal with multiple cash flows that are expected to occur in the future day. Does that make sense, right? And similarly, if we are a bond investor, the same thing for the bond, right? If we invest in the fixed income market, right? Say, for example, what I'm showing you here is Australian treasury bond issued by the government, right? So if you look the long-term bond, the maturity longer than a year, we are entitled to receive the coupon. What is the coupon? It's like interest repayment, right? So for the coupon, we are expecting the regular every 6 months, we will be receiving the coupon in form of interest payment, right? And hence, in order to work out, calculate the fire price for the bond, apparently it's going to involve a multiple of cash flow in the future, right? And therefore, we need a scientific approach to deal with this multiple cash flow occurs in different time, okay? And that is the reason we introduce today's topic. We're going to introduce some specific technique, even smarter approach to deal with the present value, future value of multiple cash flows. Okay, so as already mentioned, today we just take a little bit deeper dive into the topic. Different from last week, we deal with single cash flow, right? But today we're going to deal with multiple cash flow jointly. Okay, so is that clear? So this is a quick introduction for today's topic. Okay, so by completing today's class, we are expecting to achieve the following the learning objectives. Okay, and before we started, just a few announcements. So the first one is about the PASS program. I already mentioned that briefly in our week 1 class. If you don't want to work on your own, if you want to study this unit with some peer students, then welcome to join our PASS program, right? So the PASS program is we have a senior student who did really well in this unit will be the lead for the program. And then basically we're going to form like a study group, and then we can help each other, motivate each other, and work on the topic together, right? So I already provide a program announcement for the PASS program. Basically, starting from this week, week 3, we're going to have a weekly program on different topics. Okay, so if you are interested, you are welcome to join our PASS program. Okay, the second announcement, it is assignment. Okay, so I already uploaded assignment questions. So you can find the assignment questions in the assessment folder. Okay, if you click assessment resources, and then you will see the individual assignment folder, right? And then I already uploaded an assignment document that contains assignment questions and all the guidance for prepare the document and also the submission guidance, right? So the reason I upload assignment like yesterday, this week, is that by completing today's class, or even after next week when we complete the seminars, right? So I believe it's good time to start working on assignment. Okay, as you can see in assignment, we have 3 questions. Okay, so by the way, the assignment will be due, I think, in week 9. So we have plenty of time to work on this assignment. So there are 3 questions in this assignment, and the first question is about the present value of the money topic, right? So basically, in the first question, you are invited to work as a financial planner to help your client to make a informed decision about a mortgage choice, right? So for the mortgage, apparently it's going to be a long-term loan, right? So essentially what we do is we're going to make like a regular payment, right? So such that at the end of the mortgage term, we need to fully pay off all our liabilities, right? So in first question, you are invited to provide some insightful advice regarding the mortgage choice, right? So the topics is exactly what we'll learn in today's class, okay? The second question is an open question, okay? So it is about the topical issue, very current issue in financial market, right? So it is a research-based question. So you are invited to do your own research and then provide your opinion for those 2 questions. Okay, so it is a research-based question. Don't forget, include your reference. Okay, so whatever the articles or research paper you read on newspaper, so you need to set those papers to support your narrative, to support your argument. Okay, so it is an open question, so there's no right or wrong answer, but it is we are looking for your opinion to answer those questions. Okay, is that clear? The question 3. Okay, so we will be working as a financial analyst. Okay, so basically in this question, we need to download the real market price, right, and then perform some analytical work. Okay, so don't worry about this question. We will be covering this part in week 5 and 6 when we talk about the risk and returns. Okay, so this is a quick summary about assignment. I don't want to stress you guys out, but it is a good time to start thinking about assignment. In any case, I'm planning to schedule 2 consultation sessions for the assignment. Okay, so no need to stress. Okay, so I will be there to help you, to support you. Okay, but this is the assignment. This is your own work. I can only give you some guidance, but essentially this is your work, okay? But along the track, I will be there to help, okay? So I think the assignment is worth 40% for our total assessment, right? So now we still have plenty of time to work this assignment properly, okay? So yes, please.
So there are only 3 parts of the assignment?
Yes, there are only 3 questions in this individual assignment, okay? Cool. So we have like 2 quantitative type of questions. Question 1 and question 3 are quantitative-based question, and question 2 is like a qualitative question, right? It's an open discussion question, and we're looking forward your suggestions and your critical thinking, your opinion, okay? All right, good. Okay, let's go back to our topic, okay? The multiple cash flows, okay? So suppose we are confronting with a situation, we know that we are entitled for a retirement income stream, right? So while we are working, we contribute to our super, right? So once we retired, we are entitled to claim those money back, right? So in form of constant the cash flows, right? So suppose we will be entitled to receive 30K per annum every year for the next 20 years, right? And if the interest rate is assumed to stay constant at 10%, okay? So the question is how much this income stream worth today? Apparently, we are dealing with multiple cash flow, right, in the future. What we are invited to calculate, it is the present value of 20 cash flows in the future, right? So from last week's class, we know that $1 today is not $1 tomorrow, and hence we cannot do the simple add up, right? We cannot do the simple add up of 20, 30K cash flows. We have to consider the different timing for the cash flows, right? And of course, if we understand what we learned last week, right, and then we can easily solve this question one by one, right? But that looks a bit tedious, right? And that involves a lot of work, right? So the question here is there any shortcut to solve the problem? So I know if we calculate the present value for each cash flow individually, right? So we discount all future cash flow one by one back to today, T0, and after that, the step 2 is do the sum up, right? But I'm just thinking this method is okay, but it is too difficult. So there may be some shortcut to solve the problem. Okay, so let's just learn what is this shortcut to deal with this situation. Okay? So may I ask at this stage, while we are dealing with multiple cash flows, what are the characteristics for those cash flows? Is there any characteristics or any pattern for the cash flows here? Or are they just random cash flow? Are these random? No. Answer is no. Why? Because the cash flow itself stays constant, right? Each cash flow stays at $30,000, right? It isn't, so it is not random. And number 2, the reason number 2 is to look at the timing of the cash flow. The timing, in terms of the timing, is not random either, right? So they are all equally spaced, right, every year, right? So they are equally spaced and stay constant, right? So while these are multiple cash flows, but they are pretty regular, right? So in this case, in finance, we have some special terminology or name for those regular cash flows. So the name is, let me just introduce the name. It is called annuity. Okay, so what is an annuity? If the multiple cash flows satisfies 2 criteria, okay? 2 characteristics. Number 1, stay constant. Number 2, in terms of the timing, if they are equally spaced, then the cash flow will be, I'm talking about the entire series of cash flow, will be called annuity. Okay, so that is a strong definition for the annuity. In later part of the class, we're going to relax the first definition, first requirement. Okay, so we don't need to assume the cash flow itself stay the same magnitude, right? But we need a requirement that all cash flows, they must be equally spaced. Okay, so in this case, the cash flow is called annuity. Is that clear? Okay, right? And then in particular, we can take a deeper look at the annuity. We can classify the annuity into different types of annuity. So the first one is called ordinary annuity. The second one is called annuity due, right? So it looks confusing, right? But let me just make it simple. Just looking at the timing for the first cash flow, okay? So the timing of the first cash flow is most important attribute, okay? So if we are one period ahead of the first cash flow, okay? Today is the 1st of January, and I know that the first payment is occurring at the end of December or the 1st of January next year. So in this case, we are exactly one period before ahead of the first cash flow. Okay? If that is the case, the annuity is called ordinary annuity. Okay? But what is the annuity due? If the timing, if the first cash flow is happening today, T0, that means the first cash flow is due, right? So in this case, the annuity is called annuity due, right? Are we feeling better, right? So initially, it looks confusing, right? But just looking at the timing of the first cash flow, we can make the distinction between these two, okay? Bearing in mind, don't forget, we are talking about annuity. In first place, they need to satisfy the criteria. They must be equally spaced and pretty constant, right? And then by just looking at the timing of the first cash flow, we can classify them into ordinary annuity or annuity due. Okay, is that clear? All right, let's move on. And then we also provide some specific example. For example, for the mortgage repayment. Okay, so when we sign the mortgage agreement, we know that the first mortgage repayment will occur at the end of the month. Okay, so that will be considered as an ordinary annuity, right? And in contrast, for some like retirement income, right? So we know that once we retire, we are going to receive the payment at the beginning of the month. For example, in this case, if we are standing on the beginning of the month, that will be considered as an annuity due, right? Why we make that distinction in the first place? Because the valuation method will be different, slightly different. Okay? Does that make sense? Can we move on? Okay, let's get our hand a bit busy and then take a look at the calculation examples. Okay, so let me give you the formula first. Okay, so remember all the formula will be provided. Okay, so I already uploaded the formula sheet to week 0 folder. Okay, so for the exam it's open booked, right? So you can check out the formula if needed, right? But as I already mentioned, for this topic we will be demonstrating how to use Excel to solve those financial mathematical calculations, financial mathematics. Okay, all right. Let's define the notation. Okay, it's important. Here, apparently, we are calculating the present value. Okay, remember, it's an annuity situation. We are expecting cash flow in the future, right? So the notation here, PV is a present value, right? And that is a formula. What is a PMT? It's called a payment, right? So here it is the constant, the cash flow in the future, right? So remember, we are dealing with multiple cash flows. The cash flow here is captured by the PMT, okay, payment. Okay. What about the R? R is discount rate or interest rate. Okay. There is a tricky point. Please remember this. While we see the interest rate are always quoted in terms of annual interest rate per annum, right? But the payment, the frequency, it is not necessarily annual, right? For mortgage, we deal with a monthly repayment, right? For retirement income, we also make the monthly payment, right? Remember, I showed you the dividend, right? It's going to be a quarterly, right? So we have to match the payment frequency with the interest rate frequency. That implies there may be some adjustment we need to make, okay? It is important. Please remember this, okay? What about the N? N is number of cash flows. Just remember this, number of cash flows, okay? So, and then we can, the second formula here, of course, is a future value, right? Remember, we can move the value of cash flows freely along the timeline, right? If we know the interest rate, if we know the time of period, okay? But here, we just introduce two separate formulas to do the valuation for future value or for present value. And of course, if once we calculate the present value, right, we can work with the present value as a whole lot to calculate the future value, right? But here, we just provide two separate formulas for the valuation purpose. Okay, is that clear? All right, let's move on. Now let's go back to the earlier example. Remember, we mentioned that we don't like the hard-working, approach. We don't want to work the cash flow individually, right? So we want to borrow the established the annuity approach, right, to calculate the present value straight away. Let's just see if it works. Okay, so it seems we know all the parameters, right? So the payment here is exactly 30K, right? What about the R? It's a 10%, right? And N equals 20. Remember, we're going to deal with 20 cash flows, okay? Right? If you input all the parameters, we can easily calculate the present value here, right? But as already promised, we need to learn how to use Excel to solve the problem, okay? So what I do is I create a cash flow along the timeline, right? So here it is my timeline, right? Here are the cash flow for each period, right? So since we are calculating the present value, okay, so the present value, the function we can directly borrow from Excel is exactly called PV, okay, present value. And then you can see a number of parameters. We already learned this function last week, right? But we didn't mention some of the parameters here. Okay, let's just clarify what are those. So we just follow the manual. The first parameter we need to tell Excel, it is a discount rate. Remember, we need to match the discount rate with the payment frequency, right? And since here we are dealing with annual cash flow, is that right? So that means we don't need to do any further adjustment. It's ready to use. We can just use 0.1 because everything is in terms of annual, right? What about the number of period? Well, the parameter is called NPER, number of period, but I found that treating NPER as number of cash flow is much easier, okay? So just remember how many cash flows we are dealing with here. So in this question, we are dealing with 20 cash flows, okay? So we can just type in 20 here, right? And the next one is a payment. You can either type in or just click the reference, okay? And then the future value. We don't have any future value here, okay? So we just type 0, and the final one, you can see it is a code type. Okay, we can use 0 versus 1 to define the type. What is this? Remember, on the slides, we make a distinction. Is that an ordinary annuity or annuity deal, right? So if it is ordinary annuity, meaning the first cash flow occur one period away from us, it is considered as ordinary annuity, right? If it is the case, if this is the case, we use 0, or we can just ignore. We can just ignore this parameter, okay? So we can just type 0, or we can just skip that parameter, okay? And that is the answer, okay? And you're probably wondering why the value is a red number, is a negative number. Remember, the algorithm for Excel is they treat the total present value equals 0. After we discount back all 30K in the future, we want to have a balancing term such that make an entire present value equals 0, right? So you don't need to worry about the sign, right? So if you put the negative 30,000 for the interim cash flow, and then the present value will turn positive, right? Okay, so it seems that the Excel is pretty convenient, right? So to solve those annuity problems, okay? So I strongly recommend you practice yourself at home, right? So you should consider using Excel for the assignment, also for the final exam, okay? All right, so that is exactly the number we see in the Excel, okay? And I also provide the instructions if you do prefer using financial calculator, and that is the key, the input for the financial calculator. But I personally, I prefer using Excel to solve the problem, okay? Okay, so what about the interpretation, okay? So this number, it is the present value of all future cash flows, okay? So if the interest rate stay at 10%, we can say that we will be indifferent from receiving this lump sum payment as it is $235,000, 406, or we will be indifferent from receiving 30,000 per year for 20 years, right? Because that is the total present value for the 20 cash flows in the future, okay? Or alternatively, if I'm a salesman, okay, if I'm trying to sell you an insurance product, promises to pay you 30,000 each year for 20 years, right? Then if you learn Finance 101 today, then you should know that the fire price for that insurance product should be at this level. You shouldn't be charged more than that value, right? If I try to sell you like $256,000, you know I'm too greedy, right? So because it is overvalued, right? So you pay more than what you get, right? So here is just the interpretation of the number, okay? And similarly, we can also work out the present value of the same cash flows, right? But the function will be different, okay? So if we use Excel, then we should consider the future value function, okay? So here we want to find out the future value of all entire 20 cash flows at the end of year 20, okay? So the function that I want to borrow from Excel is called FV, right? And then you can see the sequence are pretty similar as before, right? So the first one is rate. So when you type in, the value always asks, do we need to do any adjustment, right, for the frequency? In this situation, the answer is no. It's ready to use because everything is organized in terms of the year, okay? So 10%. The number of cash flow is 20, right? And the payment, 30K, okay? The type, present value is 0, and the last one, type, we can just ignore. Okay, so that is the total, the future value for the 30,000 per year for 20 years. Okay? And we can also work out with the present value, and then by times, consider the compounding effect for 20 years, then you can also achieve the future value from the present value figure we just calculated. Okay? Is that clear? All right. Okay. Right, and here it's just additional examples. If you have your laptop, maybe we can do this practice together, right? So just take a look at the question first, okay? So here, suppose we are evaluating $1,000 per month for 1 year. If the interest rate is 13.2% per year, okay? So question is, how much was invested? Okay. So here, what we want to do is we want to invest like a lump sum payment today, and such that the payment today is able to generate $1,000 over the course of next year, right? So generating 12 monthly payment of $1,000, right? So the question is how much we should invest today, okay? So essentially, the value of investment today should equal what? The total present value of monthly the cash flows, right? So in this case, we need to solve just one more of hurdle, because here we deal with the monthly payment, right? But the interest rate is quoted in terms of the year per annum, right? So in this case, we need to understand that we need to do some adjustment here, okay? So the function we borrow is called the present value, but the rate, remember, we need to match. We need to match the interest rate with the frequency, the payment frequency, right? So therefore, this 13.2% is not ready to use. We have to adjust, okay? So we must divide it by 12 to translate it into monthly interest rate. Per month, that will be the number, okay? And NPER, how many cash flows we are evaluating here, it is 12, right? Because we invest for a year. So in total, we are evaluating 12 cash flows. What about the payment? The monthly payment is $1,000, right? And then we have a 0 future value. It is considered as ordinary annuity, right? So here is the answer, okay? So we need to invest $11,184 today. Given interest rate is 13.2% per year, we will be entitled, is equivalent to receiving $1,000 for the following 12 months. Okay? Is that clear? Here we are showing, just in case we deal with different frequencies, then we have to do the adjustment first. Okay? So the next one, just take a look at the question. It says clearly, okay? So, well, the cash flow is at the end of the year. So meaning this is ordinary annuity, right? So we invest $100,000 per year at 7% per annum interest. Okay, so what is the value of this payment at the end of the 5-year period? So here is we are dealing with a future value. Okay, we are dealing with future value here. Okay, so the function we borrow is called a future value. So we type in FV, right? So the rate will be this number, NPER 5, right? So payment will be this for the cash flow, right? For the present value, we have a 0, right? And since this is an ordinary annuity, we can skip the last parameter, right? And that is the future value of all cash flows. Is that clear? So I strongly recommend you make sure that we can do the similar the calculation using Excel, okay, to solve future value and the present value, okay? And before we deal with some more advanced questions, such as the mortgage repayment and your assignment question 1. If you have any questions, yes, please.
Just wondering, what's the present value relative to the future value?
Okay, so here remember there's no present value. We only deal with constant cash flow. Okay, so here in this scenario we have a 0 present value. Okay, we don't have any big cash flow occurring at the beginning, right? We only deal with annuity type of cash flows. So we can ignore the present value in this situation. Does that make sense?
And the other way around for the present value function.
In the last example, the present value is the one we are calculating. Okay? Okay, example 1. Here we are evaluating the present value of $1,000 per month for the following 12-month period. So the present value, it is the question we want to solve. So as such, we borrow the Excel function called present value to solve the problem, right? But essentially, the question we are solving here is called present value. Is that clear? Okay, now let's move to question 2. For question 2, if you read the question again, we are dealing with annuity situation, right? So constant cash flow, but here we are solving the future value of all cash flows, right? But we only deal with annuity, right? There's no present value here involved here, right? So yeah, let me give you an example. What if on top of $100,000 per year, you are also, by signing the contract today, you also receive like $1 million on top of this. In this case, the future value is coming from two parts. The first part is from the annuity. The second part is coming from the very initial big payment, $1 million, right? Only in this case, you worry about the present value, right? But clearly here is only annuity we are dealing with here. So there's no present value involved at all. Is that clear? All right. Good. Can we move on? Okay. Thank you. All right. And the next one is called annuity due. Okay? Annuity due. Okay? So remember what is annuity due? It means that the first cash flow is one period away ahead of us. It's one period after, where we are one period ahead of the first cash flow. Okay, so if that is the case, it's called ordinary annuity. For the annuity due, is we are standing on the same point of time. Okay, so the first payment is due today, immediately today. Okay, so that is called annuity due. And you can take a look at the formula. It is a little bit different, right? But you have to understand all the parameters first in order to use that correctly. Okay, so again, payment, it is interim cash flow, constant. Okay, R is the interest, but remember, do the matching. Always do the matching. Okay, that is the interest per cash flow cycle. Okay, what about the N is number of cash flows. Okay, number of cash flows. Okay, remember this is the figure is ordinary annuity, right? So if we shift the annuity one period forward, the bottom figure is annuity due, right? If you understand what we do for the ordinary annuity, then we already know how to deal with annuity due, right? Suppose if we don't look at the first cash flow, just for the time being, let's just forget about the first cash flow occurring T0, right? If we don't have the first cash flow for T0, that is considered as ordinary annuity. Is that right? So in this case, annuity due, it is an ordinary annuity plus a T0 cash flow, right? So if you don't want to borrow any annuity due formula, we already know how to solve the present value of annuity due, right? But I don't want to confuse you. We can still follow the formula. We're using Excel to calculate the annuity due. But I just gave you more insights where we get this formula from, because it is pretty similar. We just shift all cash flow one period ahead. Okay, let's take a look at some questions, examples here. Okay, we work with the same example here, but we know that the first payment is made immediately today. Okay, so in this case, it is considered as annuity due. Okay, it's annuity due. Okay, and I still want to use Excel to solve the problem. Okay. So that is so in total, we are dealing with 20 cash flows, right? So the only difference from here compared with last example is we shift forward the entire cash flows. The first cash flow occurs T0, different from what we have here, right? Okay, let's just do the calculation. So I'm still borrowing the present value function because I know that in Excel there's a special parameter to take into account ordinary annuity versus annuity due, right? And then the rest of the formula is pretty much same as before, right? So number of period, remember always count number of cash flows, okay? It's much easier. We have 20 cash flows. For each cash flows, it is 30K, right? So there's no leftover value in the end, so we just type 0. For the last parameter now, we cannot skip, right? Because we have to remind Excel, this is annuity due situation, so please do the calculation using the annuity due formula, right? So in this case, you have to hit 1. You have to tell Excel using the parameter 1. Okay? So that will be the present value. Okay? You can see the answer is a bit different from that one. Okay? So my question is why the present value is larger? Because we receive the first payment immediately, right? Compared with before, the first payment is occurring T1, we have to discount back. But now we don't need to discount the first payment, right? So we are better off. We receive a larger present value because of we don't need to do the discount for the first payment, right? But here, we just need to remember, even in the Excel, we need to activate the annuity due formula using the type parameter in the end, okay? Okay, so that is the present value and the instruction using financial calculator, and that is exactly the menu for Excel function, okay? What about the future value? This is the formula if we want to calculate manually, and of course we can borrow Excel directly, right? So if we're using Excel, we want to calculate the future value at the end of year 20, okay? So here we are borrowing the future value function and then follow the menu, 10% for the rate, the number of period or number of cash flows, okay? The number of cash flows. The reason I call it a number of cash flows is sometimes it's confusing because we don't know if we are starting from the beginning of the period or we're starting from the end of the year, end of the period. Quite often we make a mistake. But if you count the number of cash flow itself, okay, we never make a mistake, okay? Right, so here we deal with 20 number of period, right? So the payment is 30K, okay? Present value 0, we don't have any cash flow other than from annuity. So for the present value, it is a 0, right? And remember the type, here we need to activate, we need to tell Excel this is annuity due situation, right? And here it is a future value, it's just like this, okay? And again, using financial calculator and also the steps using the Excel formula sheet, okay? Is that clear? Before we're moving forward, okay? Now we pretty much cover the most important ingredient for today's class, and the rest of the class is just a simple extension, some variation. Okay, so it should be easy to understand. All right, let's take a look. The next one is called deferred annuity. Okay, what is a deferred annuity? It simply means that the first will have to be more patient for the first payment, right? Say, for example, if the first payment occurs in T3, right, and we are standing on T0, right? Is that an ordinary annuity? Clearly no. Is that an annuity due? No, right? Because the first payment is quite long from today, right? But it's still doable, right? Remember, we are free. We can travel freely along the timeline, right? If, suppose, we get on the time machine, right? We travel to period 2. Suppose if we are standing on T2, what is this? In this case, the first payment is 1 period away, right? That will be considered as ordinary annuity. Meaning, if we are standing on T2, we can borrow the formula, ordinary annuity formula, to do the calculation, calculate the present value as for T2, right? Okay, so this is the logic how we deal with annuity, deferred annuity, right? So that is exactly what we mentioned. So suppose, let's just move a little bit ahead. We are standing on T2, and here all the payment here is basically we are evaluating an ordinary annuity, right? And then we can just use the formula, whatever the method we learned. Okay, let's just deal with an example here. Okay. So we are evaluating a present value of 20 cash flows again. Okay, but the thing is, the first cash flow is going to happen in year 5, right? So we are too early. We are 5 years period ahead of first cash flow, right? So in this case, it seems what we learned for the ordinary annuity formula doesn't fit, right? So we have to do some adjustment, okay? So what we assume is that if we are traveling to T2, right? If we are standing on T2, right, and then it is safe to use the ordinary annuity formula to calculate the present value first, right? Once we calculate the present value for T2, we can easily discount 4 years backwards, right, to calculate the present value for T0. That is exactly the game plan we want to use to solve this question. Okay? Let me show you how to use Excel. So I strongly recommend for the first time we learn a topic, we should always, draw a timeline, then specify the cash flows. Okay? So that is exactly what's happening here. The first cash flow occurs in year 5, right? And I know that if we want to use Excel function, present value function, we are only allowed 1 period ahead of the first cash flow. Okay? So what I do is let's just calculate the present value as for year 4. Okay? So what I do is I borrow the present value function, right? And then the rate is 10%. The number of period in total we have 20. Number of cash flows, right? For each cash flow, 30,000, 0 future value. Now it is an ordinary annuity rate, right? Because the first cash flow is 1 year after, 1 period after, right? So I know that this number is the present value for T4, right? But we are invited to calculate the present value for T0, right? That is, we can link what we learned from last week. Suppose this is a number occurring in T4, then the present value for T0 is just use the rate, right? The number of period 4, right? We don't have an interim cash flow we can skip, right? It is not an annuity situation. We have a zero interim cash flow, right? So, but here, the future value is here, right? That is the value occurring at the end of year 4, right? And that's it. So just require one more step to solve this question, right? Because by traveling to year 4, we can view the annuity as a ordinary annuity already, okay? And that is exactly what we did to solve this question, okay? Next one is interesting, perpetuity. Okay, let me ask you this, okay? The greedy salesman from the insurance company come over again, trying to sell you a product, promise to pay like $1,000 per month forever. So as long as our universe, as our planet lasts, right? So the company, the insurance company will pay you constant cash flow forever. Sounds pretty good, yeah? So how much should I charge you? I'm going to pay you money indefinitely. Does it mean that it's invaluable? No? Why not? It's good to hear that you guys reject me, right? We can still work out a fair price, right? It doesn't mean I pay you money indefinitely, right, to the future. Then the product is invaluable. No, answer is no. But why? We are pretty close. If we don't have a 100% answer, let's just take a look at this. The perpetuity annuity, what is this? So it's exactly the same the situation that I mentioned. Okay, so here we deal with annuity, meaning the cash flow stays pretty regularly, right? So equally spaced, but the only difference here, the specialty here is the cash flow lasts forever. Therefore, it's called perpetuity, right? So the first payment of perpetuity annuity is occurring at the end of year 1, right? And then lasts forever. Okay, let me show you the formula first. Okay, that is a formula to calculate the present value of the perpetual cash flow. Well, the cash flow lasts forever. We can still solve the present value explicitly. Okay, meaning that is a fair price you should be charged. As a rational investor, we shouldn't pay 1 cent over than the present value, because that is the fair price, okay? But the question is, why the present value looks as this? Any clue? Any suggestions? Maybe give you 5 bonus mark for the assignment. Any suggestion why the formula is written as this? We are solving the present value of annuity, right? The only specialty here is perpetuity annuity. Cash flow lasts forever, right? But we can work with the general formula. Just look at the ordinary annuity formula here. So what is so special about a perpetuity annuity here? Suppose we are calculating, we try to answer, we try to sort of derive the formula for perpetuity annuity, right? So my question is, what is so special for perpetuity annuity? Which parameter we need to pay attention here? It's not about the payment, right? The perpetuity annuity has the same payment structure as a 10 years annuity, right? So has nothing to do with payment, has nothing to do with interest rate. Interest rate is the same for all different annuity. The only specialty here is N. Remember with N, what is N? The number of cash flows. Okay, so what is the value of N here? For a perpetuity annuity, it's going to be a positive infinite number, right? It's larger than 100. is larger than a million, right? It's even larger than a billion, right? So n is a very, very large number, right? That is a key. That is a key driver. Let me just show you, okay? What is the interest rate? It is a positive number, right? So essentially here we are taking a 1 plus r, 1 plus interest rate. Suppose interest rate is 10%, so we take a 1.1 to the power of negative n. What is the power of negative n? It's 1 over 1 plus r to the power of n, right? Let me show you. That is the discount part. Let me show you this. What I show you here, it is a number of period. So I sequentially extend the tenure, okay, the duration of cash flow from 1 year to 300 years. I know 300 years is much shorter than the perpetuity annuity, right? And then what I show you, it is I just follow the formula, the general formula to calculate this part with assumption of interest rate equals 10%, right? And then I just calculate this part, okay? So I just follow the formula to calculate this part. That is the discount part, right? So after 1 year, if I receive $1 1 year later, that is the discounted value. It's like 90 cents, right? If I receive $1 in 10 years, that is the discounted value. So as you can see, as we are staying further and further apart from the future cash flow, right? So it's reducing and reducing. It's pretty much safe to say that $1,000 in 1,000 years is pretty much nothing, right? Just recall what's happening for the inflation since COVID happens, right? It's changed a lot, right? Therefore, $1,000 in 1,000 years is pretty much nothing. We can ignore, right? So what I do here is I plot the value decaying function, right? So as the duration is getting longer and longer, you can see the discounted value is pretty much trivial, right? So suggesting if n equals what? Like positive infinite number, the value will be, that part will converge to 0, right? Then let's go back to the formula. We show that this part will converge to 0, right? And then what is left over? Just PMT over R, right? So now we can offer an economic explanation why for a perpetuity annuity we can still work out an explicit solution or answer for the present value of all cash flows last forever. It doesn't, we need to say a clearly a no, right? If I try to charge you indefinite amount of money for this indefinite, the cash flow in the future, right? Because if you learn Finance 101, we can easily solve the present value of all cash flow, even is lasts forever. Okay, does that make sense? Okay, good. Right, so here is the practice. The calculation itself becomes much easier for perpetuity annuity, right? So here, suppose we are expecting $1,000 per year, 10% interest rate, right? And given this is a perpetuity annuity, and here we can calculate, right? Okay. If I could extend this a little bit more, suppose, okay, we believe that S&P 500 index will last forever, okay? And remember, from the index, we are going to receive the constant cash flow in terms of dividend forever, right? If you understand this formula, if we assume dividend will stay constant, right, and then we can use the perpetuity annuity to calculate the fair value for all future dividend, right? So if the market is in equilibrium, right, and then we should expect that is the valuation, that is the fundamental valuation. That is how much we should pay for the stock market index. Okay, so I just extend that a little bit because I believe this is relevant, but you don't need to worry about that too much. We can learn that this topic if you learn, like if you study the second year and third year investment unit. Okay. All right, the last part we're going to cover is called the growing perpetuity annuity. Okay, so that is one further step extension. Remember, the perpetuity annuity assumes that the cash flow stay constant and last forever, right? But remember, the practical case is that just take a look at the dividend, the stock market, right? It pays quarterly dividend, but if you look at the dividend itself, it's getting larger on average, right? So meaning there is some growth rate involved here for the constant cash flows, right? So for this reason, we introduce growing perpetuity annuity. We can see clearly in the data, right? While the dividend payment can be viewed as an annuity, right? And if we assume that it's going to last forever, but we see a clear growing structure pattern in the cash flows, right? And hence, we introduce this growing perpetuity. Okay? In some textbook, it's called growing perpetual annuity. It's the same thing. Okay? Now, we just introduce one additional parameter, which is called G, to capture the growth rate of the cash flow. Remember, at the beginning of the class, we mentioned that to be classified as annuity, the cash flow need to stay constant. But here, we can relax that assumption. If cash flow are growing constantly, if the cash flow share some commonalities over time, okay, then they have a constant growth rate, then we can still treat the cash flow as annuity, right? So in this case, it's called a growing perpetuity, right? So the formula, it is a little bit different. It's a little bit different, okay? Let me explain that. First, we need to clarify that what we use in the numerator is called CF1. What is CF1? It is cash flow occurs in period 1. So we have to make sure that we are standing one period ahead of that cash flow. So what we use for the numerator must be the year 1 cash flow. Okay? It doesn't matter if we don't observe cash flow 1, because we know that cash flow is growing over time with G, right? If we only observe the current dividend, if we only observe current cash flow or CF0, right, we can still calculate CF1, right? Because we know that the current cash flow CF0 will grow by G% per year, right? And then we can reach CF1, right? Therefore, that is exactly what we learned from the formula, right? So that is a numerator. What about the denominator? We just take the difference between the interest rate and the growth rate. Okay? So the only tricky point here is we need to make sure that we use the cash flow 1 for the numerator. Does that make sense? Okay? So we need to follow the guidance of the formula. Okay? Now let's do this example. Okay? So suppose the first payment is $1,000 in 1 year. So that means it's ready to use because this is a cash flow 1, right? The R equals 10%, G equals 2%. So everything is ready, right? We put everything into the formula. We know that if that is the case, the total present value were fair economic price or intrinsic value for those cash flow lasts forever growing at 2% per year will be at that level. Okay? So that should be the interpretation for this number. Is that clear? Okay? And deferred growing perpetuity annuity, right? So here we just postpone the timing for the first cash flow, but we can easily solve that, right? We can easily solve that. Okay? So the only difference here is that the first cash flow is occurring in year 5. Remember, if you want to use the formula, we have to assume, we have to make sure that we are standing one period ahead of that, right? So here, if you want to formula, the value we calculate here, it is for the present value for year 4, right? So if you want to use that formula, that number is for year 4, right? And then we just need to further discount back what we calculate for year 4, right? So 0.1 for 4 years, number of there's no payment, the future value is already calculated like here, right? And then it is occurring at the end of the year, right? And that is the answer for T0, right? It's a deferred, right? So you just need to follow the guidance and assume we are standing on year 4 to borrow the formula. Okay? Right? So as a quick summary, on this slide, we just provide like a workflow chart, okay, to solve annuity problems. Okay? So remember, the only reminder that I want to address here is when you use the formula, there are 2 things to watch out. First, frequency issue, right? You have to make sure that the compounding frequency, the interest rate we are putting into the formula match the cash flow frequency. And second, where we need to think about if this is an ordinary annuity or annuity deal, okay? So that is pretty much everything we need to cover today. And thank you very much for your attention, and I see you guys in the seminar. Thank you, guys. Hi. No, we have 4 quizzes. So the next week will be our quiz 1. Yeah, and I think it will be week 4, 6, 8, and 10 for the quiz. And from the quiz, we have a 10%, so 2.5%, right? Yeah, and 40% from Simon, we just mentioned.
Yeah, that one. I saw that one. I was like, okay, that's also something I can handle that.
Yeah, and 50% is from the exam. So there's no hurdle for this unit, meaning you pass 50%, total accumulated mark 50 over 50%. Yeah. Yeah. So in any case, if you miss anything, if you have any question, let me know. We can have a chat.
Yeah, I might shoot you an email later because I'm a little...
Not a problem. Take it easy. Yeah. Hi, hello. Yeah, 2 lectures, yeah? Yeah. Yeah, next week. I think will be week 1 and 2. Yeah, and what we will be covering for president history will be included for the quiz. So yeah, that's week 1 and week 2. Okay.
Yeah, it's in the our wiki folder already. Yeah. So if you have any question, let me know. Email me. Okay?
No,
Yeah.
asking things afterwards on next week.
Yes, of course. Or we can make appointment. Yeah, whatever suits you. Okay? Yeah, you're welcome. Yeah. Hey, you guys. Yeah, of course. Yeah.
So, how
Yeah.
do we calculate in deferred growing?
Oh, okay. Yeah.
How do we figured out how to
Okay.
do it on Excel,
Yep.
this part, but
Yep.
then we don't know how to get this part.
This part. Okay. So here, remember, if we use a formula, we can only stay one period ahead of first cash flow.
Yeah.
Since the first cash flow is in year 5,
Yeah.
right? So you apply this formula not in T0 but in T4.
So would you do 0 point, he's getting 10%?
You take the difference between 10% and 2%.
Oh, so do you do 0.08?
Yeah. Yeah, that is the formula, right?
Oh, so 0.2?
0.08,
Oh, yeah, the difference.
right? Yeah, difference.
And then,
That number is the number we should observe for T4, yeah.
yeah.
Right, and then we discount back that value. We can use present value function.
Yeah. So
Right.
what do I write for PMT?
No, PV.
Do I just skip?
Yeah, because we don't have any interim cash flow from 0 to 4, right?
Yeah.
So
And then you
it is
plug in
yeah.
10,000? Oh, no,
No,
1,000.
whatever you have here.
We're trying to figure out how to get that value.
Oh, you just follow this one.
Oh, so you don't need to do it on Excel? You don't do that?
No, we don't have a built-in function for that.
Yeah.
We can just follow the formula because it's an easy formula, right?
Yeah.
Yeah. Remember, the formula is for like a annuity type of situation,
Yeah.
right?
Are you able to put up your Excel?
Yeah, I will.
Had on
Yeah,
there,
yeah.
Like last week, that was
Okay,
really
yeah.
helpful having that on there.
Of course, yeah.
Oh, yeah, and then some
Yeah.
other questions is, you
Yeah.
know how sometimes you type in negative before
Negative,
you put the
yeah.
price?
Yeah.
What's that for?
Yeah, because as you can see, when we use present value function, quite often we see the present value as a negative number.
Yeah.
So at the beginning, it looks like confusing, right? But we understand that the reason we see a negative number for present value is if we put the payment
Yeah.
as a positive number, we see the present value as a negative number because the trade direction is opposite. If the
Yeah.
payment is inflow, the trade present value as outflow.
But can you put it as positive
Yeah,
if you want?
yeah.
Okay.
If we change the sign for payment to negative number, then
Yeah.
for the present value we see a positive number.
Yeah.
Yeah, but don't worry about the sign. Yeah,
long
just
as
use
the
the
value-
magnitude. Yeah,
Yeah.
yeah.
And then what's the benefit of deferred annuity? Why would you rather get your money 5 years later if you can get it?
Yeah, that's for practical reason. If you build a tollway, supposedly, right now you started working, you got your finance sorted, but it's only can operation till year 5
Is
or
there
year
a
10.
benefit? Do you get
There's no benefit. It's just a practical for some. It's like our retirement saving, right? You work, you receive super, but you're gonna accumulate that for 20 years. Your first pension will occur like 20 years away,
Yeah.
right? Yeah.
And
Yeah.
what is perpetuity used for?
Perpetuity
How
used-
do you have endless cash flows? Like, how does that work?
How does it work? Okay. Yeah, it's a really good question. I think we see some example. The cash flow will last forever. Like if you invest the stock market index, right?
Yeah.
So as long as we still have a stock market, right? So we will be receiving dividends forever, right?
Yeah. Is
So-
that perpetuity?
Yeah.
Oh,
If,
okay,
if we assume stock market lasts,
Mm-hmm.
right? If the company are paying dividends still, right? We will be receiving dividend, right? If you learn some history, it's like there are some like a British company, East Indian, some sort of they promises to pay their initial, the funding investors, like this perpetual type of dividend, right, forever,
Yeah.
right? But what we're trying to figure out here is that, well, the cash flow lasts forever. It's not fair. I charge you indefinite amount of
Yeah.
money to buy this, right? Here we can still work out a explicit value for the present value, right?
So,
Yeah.
I've got a question. Just say someone buys a share
Yeah.
that produces dividends for them annually,
Yeah.
but then they decide it's no longer the appropriate investment for them and they sell that.
Yeah.
That dividend would be an annuity, not a perpetuity, because it stops. It's not
Okay.
endless
Okay.
anymore.
All right. Okay. So I think that will be covered if you learn corporate finance. Okay? Yeah. Let me give you a short answer. Even you hold shares. Okay? When the company make a dividend announcement.
Yep.
Okay? So I make announcement on Monday, and I tell the whole market, if you want to be entitled for receiving dividend, there is a cutoff date. You have to be our shareholder by the cutoff date.
Okay.
It's called ex-dividend. Okay? If the ex-dividend is on Friday, you hold a share on Friday. If you're in our system on Friday, you will be entitled.
Oh, yeah.
So while the dividend payment day is, say, the following Friday, but if you in our system, you hold a share on Friday, this Friday, you will be entitled.
Okay, cool.
You can sell the share the Monday following the Friday.
Yeah.
But because you are our shareholder in our system on the ex-dividend day,
Yeah.
you are still entitled to receive the dividend.
Makes
Okay?
sense.
Yeah, but the dividend, yeah, is pretty regular, right? So if the company cutting dividend, that will be considered as extreme, the negative
Yeah.
news, right?
Yeah.
But the fact is that in the market, we see less and less proportion of company paying regular dividend. That is a fact we observe. But there are some complicated reasons. Yeah, I don't think we need to worry about that for Finance 101 unit. Yeah,
Okay, cool.
yeah. But I'm sure that you guys are doing great. Yeah. So just keep working. Yeah.
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 Cool, thank
Okay.
you.
No worries. Yeah. Yeah. Hi.
Yeah, I'm still wondering because I asked
The present value.
actually the future value parameter in the present value function.
Yeah. Remember, always remember, all the cash flow is regular. Interim cash flow is considered as payment, right? So we don't need to worry about the future value or present value. You just follow the question to calculate that, right? And then you don't worry about it. Let me give you an example. If you are a bond holder, okay, you receive coupon in form of interim cash flow. At the end of the maturity, you also receive the principal money, the face value, $1,000.
Okay, so
So
you
that $1,000 is considered as a future value, right? For the constant cash flow, it's all about payment, okay?
so there's no future value.
No. There's no future value parameter, okay? You can't confuse this with. We can calculate future value for all the cash flows, but that is a different. What does Excel means? The Excel just means the future value in Excel within the bracket is like, do you receive another money in the future day?
Oh yeah.
Yeah, so that is how they define the future value within the parameter. Okay?
Yeah, it's different from calculating.
Yeah, it's a
Conversion
yeah. Okay?
So what we are learning today is like constant
Cash flow.
constant cash flows.
Yes.
So at a constant, so every cash flow you receive is the same. So
Yeah.
the interest based on that is like simple interest.
No, it's compounding. It's compounding. So I think we will be covering this in this week's seminar. For simple interest, if the maturity is less than a year, then we use a simple interest. If the maturity is longer than a year, most likely we follow compounding interest rate. If you see, we see a lot of power function here. 1 plus r to the power n. When you see this, that means we must deal with compounding interest. Okay?
But the cash flow is still constant.
Yeah, the cash flow is constant, right? But compounding refers to how you accumulate interest, right?
Okay.
Yeah, don't worry. Simple interest means the base capital stay constant. How you evaluate, how you calculate your interest. Compounding is you accumulate interest, right? Comes to the next period, your base capital becomes larger, right? If you see the calculation is like 1 plus r to the power n.
That's always compounding.
Yeah, that's compounding. That means it's compounding. Okay?
Thank you.
Yeah. Okay?
Thank you.
Okay, you're welcome.